Our attention to some economic data we got out this morning. Weekly jobless claims pointing to a pickup in hiring across the country. Those claims totaled 684,000 last week. That is the lowest number we have seen in more than a year. Meanwhile, the final GDP print from the fourth quarter showed the economy gained 4.3%, higher than previous estimates. Let's bring in Joost van Leenders. He is senior investment strategist at Kempen Capital Management. Joost, it's great to talk to you today. Give me a sense of where you think the economy is. I mean, we don't want to make too much of just one set of data, but it does feel like things are moving in the right direction.
Oh yeah, definitely. In the U.S., we've seen a strong improvement. We know the fiscal package that had been improved in late last year, and the additional package. So I don't think there's any concern about the U.S. economy. If there's any concern, it's that it might be too strong and that it might generate too much inflation. But that healing process is going quite fast. Probably at the end of the first quarter, or of the course of the second, the damage of the corona pandemic has been undone in the U.S. So that's quite positive, I think.
And Joost, I mean, when you think about where we're at, you kind of pair that and the inflation risks there with the continued strength in this recovery, not just the unemployment data there that Aikiko is talking about, but also we saw Bank of America boost their GDP forecast to 7%, up 0.5%, 5% for the year after. I mean, talk to me about how maybe the actual growth in consumption here might be a main driver once you get past the jitters of where yields are going in the short term, and what the rest of the year looks like for investors.
Well, when you look at consumption, the U.S. households have been supported massively by the government. So there's still a lot of money available, although it might be skewed a bit to the higher income groups. And then we have the checks that are probably being paid out as we speak. So that's going to be another boost for consumption. But I think when you look at the U.S. economy, what is positive, that you also see that indicators for business investment are quite strong. So when you look at the ISM manufacturing, where it is, when you look at capital goods orders and the growth there. So consumption is obviously always the main driver of the U.S. economy. But you also see that investment has been picking up. When you look ahead, when you can reopen the economy and people can go back to work, then those unemployment benefits will fall. Obviously, when people move back from unemployment into paid jobs, and then you have a continued support for consumption. Now, when you look at those growth numbers, they're obviously also so strong because you come from very low levels, and those reopening effects for the economy are huge. So translating that to investors, it's not a one-on-one. So what you have seen in the U.S. is that the market has been struggling a little bit, and that is probably related to that inflation outlook and to the rise in bond yields.
Joost, I wonder if you could take more of a global view here, because if we're talking about the vaccine rollout, certainly things have run along much smoother in the U.S., but of course in Europe, not exactly the case. We saw Germany just reverse their restrictions because of a backlash and pressure from the public, really, who has expressed frustration about the way in which the vaccine rollout has been carried out. To what extent do you think that this slow reopening over in Europe drags down the larger economic recovery globally?
Well, I think the prospect is still of reopening and maybe more in the third quarter than in the second. So you see the growth will be slower in Europe, and the divergence between the US and Europe will be quite strong. It's interesting when you look at markets. So far, the equity market hasn't really tuned into this. Europe is doing a bit better than in the US so far. But in other markets, you see the yield differential between 10-year yields in the US and Germany has widened. So there you see the more positive economic backdrop in the US. When you look at currencies, the euro strengthened further and has now started to weaken. So you see it in that market. In equity markets, In general, during the pandemic, equity investors have been able to look through the near-term weakness, and they have essentially done so since March last year. So the question is, when will European equities really start to underperform because of the delays? I think again there is this prospect of reopening in Europe. It's more a delay than really anything more, but probably 1 month, 2 months. But there's also benefiting Europe is the rotation from growth to more cyclical and value stocks. And that is also supportive for Europe. So that also blurs that economic difference, I would say.